Hi, everybody. Doug Robertson here, bringing you a video trade alert from Top Gun Options. Just wanted to give you a little update as to what I'm looking at today. We're 18 trading days out, basically a little over 3 weeks out from the options expiration. And this is a really good time for me to be putting on iron condors and capturing some implied volatility and some time erosion as we come into the expiration of different option series. So what I was doing this morning is doing a quick scan through. This is something I do on a fairly regular basis, and I'm looking for chances where I can find a good discrepancy between implied volatility in the market and what the stock normally does, the historical volatility. One of the things that I came across, now takes a little bit of work. You got to do a lot of sifting through and a lot of finding different things. But one of the ones I came across this morning that I really liked was NetApp, NTAP. Now, as we can see here, NetApp has a historical volatility of about 28%. Now, it's been steadily going down. The volatility, the price movement, the actual price movement of the stock has been reducing. So that's a good sign for an iron condor. And as of just recently, the implied volatility has gone very, very high. Now, this is not uncommon. We've got earnings season going on. There's a lot of things that are threats out there. Implied volatility shifting around is pretty common. So what I wanted to know is there any massive threat to this thing that would prevent me from taking this as an iron condor? Now, iron condors, pretty basic trades. You're shorting a put, you're shorting a call to capture in some income to get a credit, and then you're protecting yourself by buying a put further out of the money and buying a call that's further out of the money. Basically, a very straightforward income capturing and hedging strategy. Pretty much it's meat and potatoes as far as trading is concerned, at least trading options. So I pulled out a spreadsheet. This is something I work on all the time and just give you an idea of what we've got going on here. And started running through the numbers. Entered in the symbol, the forecast volatility. Now, forecast volatility, I take the historical volatility and then I adjust it a little bit depending on what I think might be coming up in the future. So I took the 28% historical volatility, beefed that up a bit to be conservative, ran it through as 32%. The spreadsheet automatically calculates out, tells me that the daily volatility based on those numbers is 2%, and the trade period volatility is 8.5%. So basically, a move of 8.5% up or down between now and when the options expire would be a 1 standard deviation move. So we know those numbers. We decided that based on these numbers, I'd be looking at about 30 iron condors and started playing with some of the different possibilities. First thing I did was pick out my short call. What I'm looking for on this is a delta between 10 and 15 cents. This is kind of a sweet spot that I found that I'm comfortable with, at least for iron condors. It's far enough out that you're not likely to have to manage the iron condor too much, and it's close enough in a kind of a spot where you can still get some good premium on the trade. And that's something you want to be able to have, a good balance between risk and reward. So 46 was my strike call. I protected myself $4 out with a 50 long call. And on the flip side, I tried to find a delta that matched the delta on my 46 strike. Once again, my 46 call strike had a delta of 13.3 cents. On the opposite side, 32.
Order filled.
I had a delta of 13.6. Pretty good. Nice balance there. Now, I protected myself with an equidistant long put on the other side. Entered in the average prices that I'd get. Once again, these are just bid-ask midpoints. You may get filled a little better than this. You may get filled a little worse from this. But it gives you a general idea of where we stand. So we're getting a 58-cent credit on this for a $4 spread on the iron condor, $4 in exposure. So our 58 cents, 30 of these trades gives us a net credit of $1,740. Our max risk on this trade is $3.42 per iron condor, or 342 per iron condor. Gives us a max risk of 10,000. Now, this is balanced out with the probabilities and all of those other things, and I'm fitting this into a hypothetical 100K portfolio. Now, we need to be careful with this. Iron condors have a very large loss to win ratio, but you get a high probability of winning. We need to cut this thing off before we ever get close to that $10,000 in max loss. So that's why I'm taking a little bit higher percentage. I'm planning on managing this thing. The other thing is we calculated out the probabilities of this trade turning out in our favor. We have a basically 96% chance that we are going to get our maximum win on this trade. Now, all kinds of things can happen. 96% is just based on statistical probabilities. Doesn't base it on the real world. Real world has all kinds of things that can happen. So we need to be able to be on top of this trade and manage it. We have a 97.5% chance that this trade is going to come out break even or better. So good numbers on this trade. The max return percentage on this is 16.9%, basically 17%. With the spreadsheet that I've built out, I'm able to calculate out the probabilities across all the different likely spots where this the price of the stock may move. I can figure out what the probability of the stock hitting any one of these points is, and then multiply it out times the resulting profit or loss from the trade. Averaging all of that out, giving me a probability-weighted number for that, I get an expectancy of 15.81%, which is darn good. I will take 15% return, 16% return over 18 trading days anytime I can get it. So here it is. This is NetApp. To run down through the trade again, we're shorting with a February expiration of 46 call, and we're shorting with a same February expiration of 32 put. We're protecting ourselves by buying a 28 put and buying a 50 call. The net from all of these trades comes out with a 58-cent credit, 58 cents we put in our pocket. Our goal is to hold on to that. A couple of special things we got to pay attention to on this trade. First of all, the NetApp has not announced its earnings date. Now, historically, its earnings date has been later in the month of February. There is a chance that they may announce their earnings date, and it may come up before the expiration of this option, or these option series. If that's the case, and that's not the end of the world. If that's the case, we just need to be out of this trade 2-3 days before that earnings announcement comes out. So just watch out for that. Sometime around the first week of February, we have to be on top of our game. We have to make sure that we know when the earnings date is and make plans accordingly. It doesn't make this a bad trade, just makes it a slightly different trade. So that was the NetApp trade analysis, or the trade alert. Hope everybody understood and got some value from it. I'll be looking forward to seeing everybody in class tomorrow. And good trading, and be safe out there. Thanks a lot.